Okay, good evening, guys. Ken at Tortoise Capital. This is the Friday night strategy podcast for July 24th, 2020. So, just a couple administrative notes to cover first. So, the Saturday morning podcast tomorrow is going to be a lesson on assessment. I got a couple check ins from folks from the hybrid workshop. Stevens, one of them, and who's got 4 weeks worth of data, and Catherine has some as well. And so I'm going to go through their spreadsheets and their um, uh, histograms and equity curves and all that stuff, and take a look at it and see what we can see, and formulate some coaching guidance to show basically how to look at stats from a continuous improvement perspective. So there were 0 questions from the hybrid workshop traders posted, so that frees up that time to do a lesson on what seems to be important to us right now. So we're about 6 weeks after that weekend workshop, and so there were a lot of questions the first week or two, and then they've kind of diminished. So I've either done a nice job of getting everybody to closure, or as mammals, you know, people have found what resonates or what doesn't resonate, and then are voting with their time and attention to do some things. So I feel like I've done my job there and delivered what I promised. And then a number of folks where the material was really connecting with them are continuing to do work and developing their skills through application. So that feels pretty gratifying. I feel like I can say right now that there were a lot of real benefits that came out of that course. One of them was, not to underestimate the power of adaptive trading through a pandemic, while the entire economic system of the world reoriented, and I feel like we navigated those waters pretty well. We developed some job books and templates and flashcards for concepts, over 100. Developed a couple katas along the way, and those I think are very tangible benefits that help us take a student-centric approach. That was actually the topic of conversation I had with a couple business school professors from the University of Chicago Business School, who have started a global multidisciplinary project on practical decision making under conditions of uncertainty. They're trying to figure out how to blend entrepreneurial thinking and opportunities with risk management and critical thinking and creativity and reframing on the fly. And how do you do that with the use of mind maps? And one of my former students who is training with industry is getting a graduate degree from there mentioned my name, and so they have viewed some of the videos that I sent them. And the guy says to me this morning, "Hey, your 20-minute discussion on the challenges of critical thinking and practical decision making is my entire 10-week course in an 8-minute video. How do you do that?" So, practice. So we're going to be taking a very practitioner-oriented view of that world, and I'm excited to be able to work with some really excellent scholars and practitioners and business people from profit and nonprofit, some international political staff as well. So I think it'll be pretty insightful for me, and I hope to refine my thinking about what it is that we do. And the goal is, in all of these things, is how to accelerate the learning of people who want to acquire some of these skills. And so that's really what I'm trying to do with the hybrid course and the ecosystem that we have. And I'll keep you posted on how that shakes out. So, University of Chicago project on decision making. All right, so let's see what happened today, shall we? So this whole week, as this this blue box is today, in the yellow, and then the whole week. So we've had over a 10-day period a pretty nice 10-period regression line, but the last 2 days have featured this kind of this sharp sell-off from the 10-day high. It's been like this. So that doesn't feel very good going into the weekend. That feels a bit troublesome. Especially, when the week started off so well, like this. Um, Net for the 10-day period is still it's basically flat. I mean, if you take a look at where it opened 10 days ago into where it closed, that's basically a wash. More of this grinding sideways. Um, and then, for the week, it was actually, if you see where it opened and where it netted out, it was actually negative for the week. And that's after first having, you know, climbed to the heights and then sold off. The net over net, not so good. Um, so this feels more like the tactical backing and filling and bird in the hand versus two in the bush kind of a week and a time frame. And we're 100 days away from the election, and Trump floundering left and right, and Biden basically invisible. I mean, this is like a Tesla on autopilot in version 0.8 of the software, where you're not really that confident in the robotic trading, the artificial intelligent driver. I feel more confidence in the Tesla AI than I do in the governmental AI at this point. Charlie Cook, who's a well-respected political scientist, is forecasting Democrats taking the Senate and the House and the presidency, and you wouldn't have bet that way 6 months ago. So things can change pretty quick. Boy, I watched a really good podcast interview from May, or about 10th of May, with Raoul Paul, who's a hedge fund manager and global economic strategist, and Kyle Bass, a hedge fund manager from Texas. And boy, was it ever thoughtful and pretty good strategy. Now 2 months later, looking back, the things they were talking about in May were pretty darn good. And they echoed a lot of the things that we have been talking about in terms of re-engineering of the economy and currencies, and shifting of economic power, and then some of the impact on currencies. And the idea generally being that, they don't see any better place to put money than those U.S. large caps anyhow, because where else do you have anything like storm-proof safety in the world? And with negative real interest rates, you're almost driven to equities. And so where are you going to park lots of money? So if we can think like big money, the U.S., in spite of the turmoil that we're seeing, is still pretty attractive. So that's going to continue, I think, to be the theme, for the weeks ahead. Looking at the election, in spite of the turmoil, where else were you going to go? I thought there were insights about Hong Kong, China, and the effect on currency trading was especially well done. basically drawing some historical parallels. And I've made a study of Asian culture and countries and history from about 1800 onward, and boy, they were sharp, right on the money. So this week closed pretty poorly, and all of those big gains where we had, Monday, Tuesday, and Wednesday, and even in the morning on Thursday, it was, pushing that new 10-day high and 30-day high each time, and then just, the bottom just fell out of it for 2 days in a row, and is now, let's see if I can zoom in here a little bit. Yeah, we're about this sell off from the 10-day high down to the close. Here's where the closing price was. That's a 1.96 percent sell off. So about 1.5 ATR sell off in 2 days. So that's not so good. All right, so let's take a look at some of our indicators here. So that RL10, the 10 period regression line, still positive, although you will notice that it has crossed the baby dragon today. So that it takes basically 2 days of rolling over for that RL10 to come back and cross over the baby dragon. So that's going to be a warning about potential changing from summer to fall, and it warns about the potential of the RL10 crossing the dragon. Well, price has already crossed the dragon. So at those major turning points, you can see how quickly price will move away. And now the RL10 is pretty quick. It's already got 2 days of rollover and pointing the way downward, while the RL30 extension is still positive, and the dragon extension is still positive, and the PSAR level and slope is still positive. But right now, with the close here at like 320.8, and the daily low of 319.25, and then the PSAR at 318. Well, that's most of that slack, that nice little buffer that had been built up, has really disappeared. And then on Monday, today's low of the day is basically going to be where the PSAR ends up being. So there's really not that much buffer between the low of the day and then coming all the way down to the Bollinger Band mean at 314.3. There's not much support in there at all. So it crashed through some significant support levels today. It crashed through the skin of the dragon, the spine of the dragon, the Z1 where it finally closed, and then the lower skin of the dragon. So all of those little checkpoints didn't stop it today. So none of those held. So now we've got the PSAR, the Bollinger Band mean are the next sets of targets to the downside, and the space between the PSAR and the Bollinger Band mean that could disappear. That could get covered pretty fast. If this If it opens and crashes through the low of the day, and then the PSAR doesn't hold, then it runs down here pretty quick. So this is about where I want to have my second position in. So if the low of the day crashes, I want to be short, basically getting into the red zone. And then I want to have I got to have a second position right around where the PSAR cracks. So the instant the PSAR cracks, I want a second position because I want to have two positions going short to come down here to the Bollinger Band mean. And then if the Bollinger Band mean fails, then that's where I would want to have, I want to be adding my third position. And then if the 10-day low cracks at 312, then we'd have three positions free and clear. And that would represent, probably 2, 4, that'd be about a 5% sell off. The 10-day low is about a 5% sell off from the 30-day high. And that would trigger some very significant concerns. Because now you would see that all of this support in here now disappears. Then if this 10-day low breaks, well, then it's coming down here pretty quick. And so then, the next move down is to Z1 at 307, and that'll go pretty quick too. Now, I guess the good news, if we're going to see it both directions, because after all, the dragon is still sloping up, nothing wrong with that. So if it can break out of the, today's yellow zone, I want to be long. And I think I'm trying to decide if I want to get a second position here or if I would want to wait to really clear that previous 10-day high. On a swing trade, I think I would only play one because I don't really want to hold a swing trade long in this because I don't have much belief on continuous days of follow through. I'm more than content to just play that with intraday turbo positions and take what we can get, at least with the broad equities. Now, something like Wheaton, I have a nice swing position on that one already, but that's because it's a defensive play. So I think I would add a second position if it clears this 327.3. I think that's where I put my second position in. But so I'm going to be more aggressive with swing trades on the short side and getting those second positions in earlier because I think that's where the runaway moves are more likely to be. Let's see. Let's see what else we can see. So our 10-day range from 327.50 down to call it 312. It's about 15, but that's about a 5%. So 4.72% is the width of that 10-day range. And this rollover of the intra-week rollover, it started well and then selling off just is not. It's tactical trading right now. If you needed more evidence, that's what tactical trading looks like. Now, you can get short bursts like here we saw in this week. After some sideways, in a short week, you got a burst, and then a sideways and a sell-off, and then a 1 to 2 day burst, a sell-off, a 3-day burst, a sell-off. So this is definitely a bird in the hand versus two in the bush, and locking in those gains and resetting your expectations. And I think that lasts for 100 days till till we see the election results. The policy implications and the shape of the economy and the relationship with global trading partners, all of that is so vulnerable to enormous change that I just feel like the folks that made their money in the recovery from the sell-off are if you're me, you're in your turtle shell, your little tortoise shell there, and locking that in and waiting to see which way the wind blows. I don't think that's dumb. I am directionally neutral for going into next week. I do not have a directional bias at all. If anything, it's my expectation is to the downside. That would be the least surprising move, in my view. So if that happens, I'll be quick to exploit. But I also know that when I do have a bias like that, that the other side of it can also be a very good trade as well. So I'm mindful of being ready to go in both directions. So if I was going to try to summarize that, I guess I would say no directional bias, but I will favor shorts. No long swings. And I'm going to put that in an asterisk, except for something like wheat and precious metals or treasuries would be that kind of an exception, where weakness in equities actually makes both of those better. So I say no long swings, but that's with a caveat in there. I'm going to be aggressive on the short side, and then the 10-day low is critical, in my view. This is going to feel like the longest 100 days. There's a really good movie with Charlton Heston, 100 Days at Peking, or maybe, I guess, 55 Days at Peking. This is going to feel like 100 days in D.C. That was, turn of the 19th to the 20th centuries, and the experience of in the Boxer Rebellion and the Western imperialists and the absolute chaos that ensued, and how little things have changed. All right, let's take a look at what worked. So the S&P was weak today, so we'll see what was worse. So the S&P was minus 0.63, the Dow was minus 0.7, IWM minus 1.5. So all three of the primaries in the U.S. were down. And, the worst performers here, let's just look at the top seven, I should say. Twitter minus 2.3, Triple Q's minus 3, Virgin Galactic minus 3.5, the triple tech sector, TECL, minus 3.6, Tesla down minus 6, Nikola minus 11.8, Intel minus 16. Now, made some nice bank on that one. We're going to see that intraday tactical trade. That's another example of finding the mover. So this morning, Intel was down at one point like 17 or 18%, and then staged a morning recovery after a consolidation in a Z3 pinch breakout, and that rewarded very well. But there was no way I'm going to hold that as a swing trade. So that's a case where this particular stack of, ranking it by percent movers helped me find the movers and get positioned. But when seven, the bottom 7 performers are all your tech heavyweights, that's not good. And at the same time, the other things that have been working this week, energies and materials, well, there's oil exploration was weak, Goldman, Facebook, healthcare, tech, the energy, ERX is the triple energy sector, Devon Energy, Cliff, Pfizer, Simon Property Group, all the usual suspects were bad. So there was no joy in Mudville today. Microsoft was a little better. Energy was a fractional better. Basic materials minus 3.4. Walmart, Google, Apple didn't quite lose as much as the S&P, but no real joy there. Finance down a quarter. Treasuries basically flat. Consumer discretionary 0.18. Brazil and Home Depot. Let's not lose sight of Home Depot. Win or lose, they're just crushing. So Home Depot up 0.6. Mexico 0.6. Nvidia. Now here's the case that we talked earlier this week about the pair trade between Nvidia and Intel. Intel down 17% today. Nvidia up 0.6. There's Amazon still inching over the 3,000 mark. Silver a good day. The triple inverse energy +1, and then Wheaton just continuing to march at 5.14%. I mean, Jiminy Cricket, that was just so good. So that was sort of the theme the whole week, that no single sector really was persistently good all the way through, but some of the non-tech individual companies that are well positioned to endure the uncertainty of the next 3 to 6 months. Home Depot, I think Microsoft is going to do well. And then Amazon, boy, he's going to end up owning the world. Probably already owns it. I just want to take this moment to look at a couple very significant trades in the sense that they're just absolutely routine. So here is, this is Wheaton. So here's where it opened, and then it had an up, a down, an up, a down, and an up in the first 5 minutes in that box. And then it pulled, then on the 6 minute, it made a higher low, and then took out the previous close on the 1 minute. And that just felt like enough to me that that as soon as it got back above that 5 minute closing spot, I just went ahead and bought it. And treated the low of the day as my minimum manageable risk box. And this is sort of a normal size for me, 30 cents in Wheaton, and it's trading at 51. So that's about like a 0.5%. So 30-cent risk. So if I'm entering about 51.30-ish, and my stop is down here at the PSAR dot at 51.05-ish. That's about 30 cents per share on the initial stop. And then I just adopt the Wu Wei exit. I just keep it in place until the PSAR gets like 1, 2, 3 dots above my entry, and it was crossing the VWAP already. So I just felt like, yeah, this thing's probably working. And the river is starting to flow up. So at this point, price is way up here, and I sniper accelerate my stop just to here. And at this point, with market weakness, and this is a narrow company, I just said, you know what? I'm just gonna track it with the PSAR dot, and I'm just gonna take that. Maybe could have done better up in here with the a testing of the Z2, and then it rolled over. But the difference might have been 10 cents. So I'm satisfied with this, as opposed to having the manager. Now, if I just kept the manager at the Bollinger Band mean, well, then this stop would have been in place until about here, and then I would have picked up the Bollinger Band mean stop. Now, this got out pretty close to a bottom tick on that sell-off, and there was another re-entry on this, basically at 52, right about here, and then that thing ran up. As you see, it closed at 53. So the second trade on this one was very good. But just to show you the numbers on this, so with a $400 risk and 30 cents per share initial stop, I'm buying 1,300 shares, and at 65 cents a share, that's about of capture. That's about a $600 or $700 gain right there on basically 1.5, almost two execution hours. Yeah, and then there was a even better trade on the next one. So that was Wheaton. While the rest of the equity stack was suffering, Wheaton was working, so find them over. So this one was Intel, and I really should step out of that. I gotta look at show you the larger chart so you can put this in greater context, because you don't really feel the magnitude of the sell-off of this chart. Let me call that up for you real quick. I thought I already had that opened. The main logic, I'm waiting for TC2000 to open up. The main logic was a big gap down, and then a moderate continued sell-off. And my thought to myself was, after a bad earnings announcement, are we going to keep using computers in the future? I think so. Are there a lot of them going to have Intel chips? I think they are. And so there was about an hour's worth of sideways support, and then this move here was like the recent low, and it gave me a 1, 2, 3 entry, and this was like a 50 cent or 40 cent initial risk per share, and that's about a normal MMRB for me on Intel, and so I just went ahead with it. The winter, you'll notice, had turned to spring. The winter had turned to spring, and it had a set of higher lows. And so by the time this felt like a washout, and then a 1, 2, 3 to catch up. So I used the Wu Wei exit again, and I just took this as my working low. And then when the PSAR dots got 1, 2, 3-ish above my entry. I just used the sniper move, got him up to the PSAR, and then was planning on tracking just with that. And then when this moved out here, this felt like a hesitation and starting to move again. And then you can notice that we're now about 45 minutes into the session. This is starting to expand to the upside. And that's how much I was willing to give back from that high. It felt like this was getting ready to run. So I moved that sniper manager exit right up here. And then my plan was to just lock that in place and then pick up the Z0, so the Bollinger Band mean. Once the Bollinger Band mean were to get above this solid red line, then my intention was to use the Bollinger Band mean all the way up. This thing moved up to 5180 from here pretty sharply, pulled back, and I took a sniper exit at 5080. So this is another one where, a couple execution risks really paid off well. And so that was an example of almost like a tale of two cities, the tale of two movers. One of them, Wheaton, has been very, very strong and was continuing to show strength while the rest of the market was suffering. So that was in an extreme strong play to get in. And then Intel was far and away the worst thing in the stack, and it just got hammered, but then found about an hour's worth of quiet, and it felt like a bottom had been put in, and so I was ready to speculate on that one. So let me find Intel here. Yeah, so as a matter of perspective, this is the monthly on Intel. You see how far down that got smashed today. On a daily in Intel, yeah, it was that kind of day for Intel. Enormous gap down, and then very harsh sell off, and then an intraday recovery. So all the pain is already baked into the cake. This is another reason, by the way, if you need one, where I am reluctant to hold swings on the long side because of reasons. This feels very vulnerable to me. But on the intraday, it's a completely different story. There's the size of that sell-off. It's huge. Enormous sell-off. So then just want to show the part that matters. So that the moment of entry was after this. This, I think, let me go look at that chart, get the exact time. So the entry was here at like 9:55. So here's 10 o'clock and there's 9:45. So that this little spike down for the low of the day is at about 9:55. And then this entry right here as the dragon starts sloping up. That turns out to be the bottom in the dragon. So that 1, 2, 3 entry actually feels pretty good. This is the same trade. Like if you wait for it to cross all together, you end up getting about the same entry, about the same trade. So now when we look at yeah, here's that. This is that spike down, and that makes this that 1, 2, 3 entry. And as you can see, that Bollinger Band mean, manager, and sniper exit works all the way up into here. And when I was managing that, I ended up taking a sniper exit there, and I didn't re-enter on that one because I was nervous. So I didn't. So I have a half position from here because this did not get me out because it didn't break the Bollinger Band mean. So this last leg up just has a half a position, and I just stayed with the manager. So I was really satisfied with that one because that's going from like $50 to 51.50, and that's a 3% move to the top of that. So that's a case where, you know, the sniper underperforms the manager, and it was a matter of lack of will on my part. I wasn't in the zero state and couldn't get back in. I should have, could have, didn't, and it is what it is. I was tempted to try it again here, but I just at that point had resigned myself to just being trusting the manager on this one. So I'm going to continue to stock Intel, you know, going forward because it just feels like, you know, all the pain and suffering has been baked into the cake. And really, the story of this day was after that sell-off, there was some buying pressure, which brought it back above the VWAP, and then it just that VWAP was just solid all day, and there was nobody wanted to buy it here and hold it over the weekend. So that just feels like a long-term natural normal price. And then if we zoom all the way back out on the weekly, you can see that now the last time it was way down at this level, which is Z-2, is like way back over in here. There was an opportunity for some significant gains. So even if you are going to buy it around 51 with about a $5 stop in here, so buying it here with a 10% trailing stop, what's the risk? 10%. Oh, and then you have, so if you're buying it at Z-2, there's Z1, Z0, Z+1. So there's three levels of gains to get it back to where it was. So there's a long-term upside to Intel that's already baked into the cake. Now we could compare that position to NVIDIA, the other chip maker, and now on a weekly basis, oh yeah, well, NVIDIA, of course, because they're winning in the chip wars because of their expertise in graphics. And as more and more computers are leveraging the power of graphic processors independent of the main processor to run, you know, graphic intensive games and entertainment and all that, NVIDIA has just really figured out how lucrative that market is. And it just feels like Intel has missed the beat on that shift in the market. So NVIDIA looks to me like the one to beat right now. So just a preview of coming attractions. So this was from Stephen. And so this is his last 4 weeks, 174 trades. The best one was a 4.7. Worst one was -2. 69 wins, 101 losses, 4 scratches. So about a 3-2 loss to win. We got to work on that. But a 5-3 win to loss rate. So what we got to do is eliminate these losses greater than 1, and I think we're going to get there with standard normal position sizing for execution risk, so that when you have a very narrow distance to the PSAR flip, and then you get kicked out on noise, and you're taking a full 1 hour loss. That we want to try to normalize that. So we can. There's some good things to fix in there. The system quality number is higher than noise. This is at a level which says, yeah, we probably have a system that's now under control. And all we're going to do is we're going to work on eliminating this stack of losses greater than 1. We're going to try to move half of this stack from the one loss over here. So we're going to try to nudge everything to the right a half an hour. So what you got to do is go through your average loss is minus 0.6. So what we're going to do is we're going to want you to, I think, take a look at normalizing the size of the risk box. So now it's always the same size poker chip. So you saw me do that with the 40 cents in Intel and 30 cents in Wheaton. And we're going to see how that works. But I would say in a time when the market has been really difficult for follow through, this is something that you can build on here. No huge losses, pretty controlled. And I think that's pretty good for a guy that has only studied the SSC and hasn't even gone through the hybrid workshop yet, but is learning by doing in the wood shop. So this is, I take this to be a very promising situation. This is Antonio's, this is his breakout trade here in EWZ, his first big one. So well done to Antonio. There's his a 10 execution R, and he plays here's a low, a higher low, and he plays the supported spring crossing. Didn't add a second position, but thought about it. So if this is 10, if he adds the second position here, this thing could have been 15. But a beautiful exit right there with the sniper. So good job on the annotation. Well done, sir. Just I feel like you're turning the corner on that. Well done. I want to shift now to the weekend report, and I just want to. I've been, researching into actual improvements in performance versus hype. And this, I came across some things about, false gurus and whatever. Action faking, doing things that make you think you're making progress when you're not. That's not a new thing. That's what, if you look up action faking, I'm more concerned about fooling myself or rationalizing. So what this guy was calling action faking is really nothing more than rationalizing what Musashi would call engaging in useless activities, doing things that are not making you better or are not connected to your primary mission. And my dad's favorite saying was, don't confuse activity with results. So we want our actions to be purposeful and intentional. We want to be relatively efficient so that the cost of taking those fruitful actions is cost effective. But if you're effective, you can pay for efficiency. So we kind of want all of those things. And so how do I know? That's sort of what is my management system that lets me figure out if we're making progress or not. So with your permission, I want to go, I'm just reminded I wanted to go look at something Catherine and I were talking about today. And Catherine, who is also a hybrid trading workshop person who just jumped in and started going, said, "Hey, has anyone else been having a tough week? Might just be me. Hope you're all well and safe." And this is some of my initial alerts, like Intel. I had I covered an Intel short, and then saw, hey, it's on sale, 17% off. Are we going to use computers in the future? Possibly. So entry at $49.95, and that, so this is where I'm working those two positions. And so now this is what I wanted to say to Catherine. Catherine, what does a tough week mean? What's the purpose of framing it that way and putting that label on this week is a tough week? What's the purpose of that? Words matter. That's an interpretation of what's going on this week that you're choosing, and then that word now starts having power. Here's a different frame. A different frame would be a visual picture of where your performance is on a control chart, such as the one Stephen posted and that I just showed you, so that we could see a rolling 30, 60, and 90 day or a 90 trade line, and then make contextual judgments, which may lead to a course of action to adjust the machine and to tune it. While I was BSing around, the Wheaton stop was hit in a routine way. Pavel did a nice kata 2 on Nikola Motors, and Catherine showed her Excel sheet here, and some more numbers down here in the histogram, and it just looked like some sideways trading and not much follow through. It's the kind of market that it's in. And then Catherine responded to me. She says, well, I may have to look at my stops and how close I'm trailing. I'm conscious of taking a full R loss, so possibly I'm tightening too quickly and then locking in a fractional loss instead of the wu-wei effortless action. You're gripping the sword too tight. I've also found this month that as I've been completing my trade journal, I'm overly aware of my cumulative balance, which may be having negative effects on my zero state. Oh, okay. So that sounds to me very different than, oh, it's been a tough week. Because now we have, it's a tough week as a conclusion, but without details. This was a description of some specific things that were troublesome. That's a world of difference, because each one of these is now like a gripping point that we might be able to contend with. And so I provided the trade log template in Excel and the Campfire in order to give her a way to produce that. Meanwhile, the Wheaton and the Intel trades worked, and Antonio posted his. So what I wanted to say was, by adding a 30, 60, and 90 rolling expectancy, a trade set, the last 30 trades, the last 60 trades, the last 90 trades, you get a short, medium, and long-term rolling expectancy curve, so we can see what the trends are. And here's an advanced pro tip, that if you can actually take that stream of R multiples and construct an RLCO framework. And in the same way that we can evaluate the health of a symbol, you can assess the health of the equity curve and the expectancy. And no, so that's a completely different way of framing the week. Measure twice, cut once. Well, study it twice and then label it once. And that's the difference between thinking and feeling. It feels like it was tough. Well, that's just a feeling. So what? Here's what I think about it. What I observe, and I study the facts. Now I have something I can actually work with. So then I asked her, now think about the walking man and the 5 ways of knowing this weekend, and post a reflective learning entry in here on Sunday. What knowledge of the head, heart, gut, hands, and feet are activated by this reflection? And what are those voices from those 5 centers representing for you? And what's the purpose of the communication? And I said, you have identified a couple things to investigate, and now you've got to do some due diligence with your accountability partner, her husband, before she tells me what she's going to commit to. So when she comes in with her recommendation for action, think about that speech from earlier this week. I'm not interested really in, I'm interested, but that initial impression or off the top of my head, no, I want to see some due diligence and ownership of the issue, and then some commitment to a certain course of action. So when she briefs her plan of what to do with that data set, we should be able to see the connection between the evidence, the conclusion that she draws, and then an action plan that starts addressing the things that she prioritizes. So that's taking control of your environment and being an actor instead of a reactor. The locus of control is moved back inside you, where you're taking the data and the evidence and using that to fine tune that engine that generates the R, as opposed to saying, wow, it was just a tough week. You haven't told me anything. Of course it's a tough week. Every week is tough. That's why we call it work. If it was easy, it would be play, but it's not easy. So it's work. And we bring that professional thick skin to the work. And that's just coming from the word, oh, it was a tough week. So Robert Gardner liked to listen for those kinds of, he called it a tell, like in poker, something that reveals a deep inner state. And for me, it's important for Catherine to get beyond the feelings. We have feelings, so you got to feel them. Yeah, but so what? We all have feelings. That doesn't feed the bulldog. What feeds the bulldog is taking action on the evidence that is connected to your priorities, your purpose, your vision, and an action plan that has had due diligence applied, and it looks like we're getting after the things that matter. Her system is under enough control right now that she can start varying 1 or 2 things to see what that net effect might be. Like she is concerned about, she's looking at her chip stack instead of just studying the objective trade frame. So I'm going to recommend she might think about, hey, at the end of each week or the end of each day, just sweep the gains to one side and give them to your accountability partner to make bank. And so you're always starting the week in a zero state with enough trading capital, so you don't feel the weight of those extra earnings that you're trying to now protect. No, you're just you pick up your little lunch pail and the raw materials to go to work, and you start carving away, and you let the front office or the back office worry about what to do with the excess gains. You just start each week at 0 and go forward. You let somebody else tell you what the size of the value of the chip is. You just work on putting your chip down and taking it off when it needs to and betting according to the rules, and don't let somebody else worry about what it means in terms of dollar gains and whatnot. So there are some things on the psychology side. And so when I asked her to think about the walking man, what I'm saying on that is this idea that each of these 5 centers looks at different parts of what we're doing. So you have your head, which is concerned with those rational rules. So there was a part of her that ended up becoming rational. And where was that? Well, when she started talking about the possible issues with a rich description, she was now getting into the world of facts and um, and concept and theory. She talked, in the gut is that emotional center. And so that's where those key phrases, tough week. Things feel tough. That was not an objective measure of the performance of the expectancy on an equity curve over time. So it was not that. It was not from the head. That was a negative emotion, a little bit of discouragement. So we're not going to make our decisions on what to do to begin the process of improvement. We just note that there's a certain amount of energy that's available that comes from this emotional center. So we got to convert that as a source of motivation. I want to reduce the discouragement. I want to use that as motivation to get better at my craft. So in the heart is that kind of vision and purpose. That's going to be another source of positive energy, a source of energy, but that's going to be positive energy that's going to pull you forward. And you want to get away from those feelings of disappointment. So you got these two different energy centers in here, the heart and the gut, who are providing emotional energy. Then there's the knowledge of our hands, which is the how to do things. So what I was giving her some instruction then was a couple things. How to convert the energy, plus and minus, into motivation to do work with her head and hands. So the knowledge of the head is going to be that theory, and the knowledge of her hands is going to be the practical know-how of how to track those trades and to make those assessments and to go through prioritization and how to use her accountability partner. That's the how to do work. The theory is what to work on, all things considered. And then the practical of the hands is how to get it done. So this really represents a one step. And so the knowledge of the feet is how to journey and how to endure over a week that didn't feel good. It generated, tough feelings. So tough. So toughen up. And then it won't feel tough anymore because you out-toughed it. You can convert that feeling of toughness and say, oh, I actually expect to feel like this. So now there's no surprise. and it loses power to interfere. And you're not going to be discouraged. You're not going to be discouraged. Why? Because of the energy of the heart, which says, this is my calling. And when I master this craft, the payoff is going to be so good. So I'm not going to get discouraged by the short-term difficulties that the gut feels, because I'm learning how to walk this path and how to toughen up. And by learning the knowledge of the hands and the heart, I'm going to be able to make progress forward towards that goal. That's the backstory between. So now if you look at this in psychological terms, like the iceberg, all of this stuff down here in the subconscious and the unconscious was triggered by this visible thing of a, hey, tough week. That's what's on the surface. That surface feeling. Those feelings bubbling around down in here launched that up into here, and then we gave voice to it, gave words to it. So all we're going to do is just acknowledge it, but we're not going to use that to make a decision from a feelings place. We're going to go through a process with our hands and our head to take the data that we have patiently collected and then turn that into an action plan that's driven by the positive motivation of the heart, managing the negative emotions of the gut. We're going to use our head and hands to do the work, and then our feet are going to learn how to make this journey one step at a time and just keep going. And so in the future, we're not going to be surprised when that feeling that comes out of the gut, we're just saying, oh yeah, that's just like that other time, and it really turned out to be nothing. So noted, I acknowledge it, and I'm just going to keep doing what I'm doing with my craft knowledge and getting better and better. And you just learn to endure that. Learning is learning how to suffer. So that's the work that Catherine has in front of her. And Stephen, you got the same challenges to work on too. But this is, unpacking the words that we use to describe what's going on. Because we are in input, process, and output machine, living in an ecosystem. And when the signals come in and do whatever, the output is, how are we going to describe that in words? Tough week? That was nothing. I know what a tough week is. Tough week would be losing -2 every day for 5 days in a row. That would be a tough week. That's a -10 execution R. That would suck. That's not what she experienced. So that's not even a tough week. Could have been much worse. So when you listen to that words that we use to describe the conclusion that we're drawing, remember, that's a choice you get to make about what's going on in here. You say, well, that was just what it was, and that's just another week at work. So if I can take that was a tough week and just reframe it and say, you know what, that was just a week at work, and she's working hard, and she's learning, and she's going to take the data that comes from that experience and get better at her craft. And so that's where mental toughness comes from. That's where resilience comes from. That's how we get better. Okay. So that's what I wanted to say about that. Now we're ready for the weekend report. Alrighty. Drop me a note if that, put a comment in there if that you found that to be helpful. That will let me know if that's the kind of stuff that's of benefit to you. That's what coaching sounds like. Let's see. And stand by. Almost ready. Page. There we go. Okay. So some things to notice. Still bullish normal. That's good. Only the very long term is overbought. Intermediate term has come back into normal. But the 3-day piece, we're seeing some market weakness. So it's very vulnerable to the downside right now. And we already know that the 10-day low equals the trigger, because that is a 5% loss. 5% loss level. So that matters. We have a risk Z that is still giving us some positive signs here for the long side swing. I'm going to call that long swing by exception. And I still think that's going to be tech. And maybe a, God damn it, I did it again. Some sector cycling. Come on. My fingers flinched and hit that pen button again, and I don't know why that freezes, and I don't know how to unfreeze it. So we're just going to drive on through it. I'll just narrate it. Sorry. I got to figure out how to do that. Stupid. All right. So the blended monthly rebalancing still featuring, tech, and this has been very good. That decision to add Wheaton, and that's made that genius. Well, it's made it very good. The Dow leaders are still, Apple, Home Depot, and Microsoft. Clean energy, silver. ETF2 still at 100%, so full exposure. On the this little pullback on the monthly is not significant yet, so it's got a 315 is probably the price level that makes that safe. And then you could just look at the real buffer is the dragon. Is the width of the dragon. And then if that fails, it comes back to this monthly low, the 3-month low, and if that breaks, it's look out below. To the upside, it's we were so close to an all-time breakout that it just doesn't feel supportable. And it was just, what's the driver? I'm not sensing a lot of greed out there. Like, I got to hurry up and get in. No, I'm not sensing that at all. On the weekly, we had a tight sideways cluster and then this nice breakout. But then you notice this week was problematic. It closed fractionally lower, and we're very close to rejoining the rest of the market here at 315. And 315 looks to me to be that significant price level. So that's the wiggle room. And then it's that protection down to the Bollinger Band mean just below the dragon. Got to hold above those two. Those are the support levels. And then if the weekly PSAR flip cracks at 285, man, then it comes all the way back down here. And then it's the original PSAR. So those are the price, those are the price bricks. The last time it was down in this range, it voted up those two bricks to the upside. So those two have got to hold. But if that Bollinger Band mean breaks on the weekly, then it's troublesome. And that's 300. So 300 on the S&P for SPY is key. Excuse me. We've already looked at the daily. So 300 over here is that Z2 level. And then the 10-day low is at 312. And we said 315 was significant from the weekly, and that's basically the Bollinger Band mean. Those are your significant. Those were the two price levels that mattered. Yeah. And that's why I'm watching that daily low. If that breaks, oof, this gets ugly in a hurry. So what I just wanted to show on this one was that supported fall crossing that gave us this kind of bump, sideways cluster, and then when this broke, you get that symmetrical move down into the close. So up, over, and down, and right back where we started. Yeah. So lack of follow through completely. The Qs just got smashed. The mid caps surprisingly held on really well. That's kind of the stuff. Maybe I need to add that to my stack just to start watching that unfold. And that was the best performer, among the U.S. indexes. So the DIA was down minus 0.8, SP down minus 1, but the mid caps up 1.38. And then treasuries feeling pretty good. Energy had a nice big rebound. I think that's just a rebound from oversold conditions. There's no reason to believe that there's an uptick in demand in the near future that would give them some kind of recovery. So I just think that was an instinctive reaction to such oversold conditions. And what we're seeing now is that the, the tech leader on the other. And so just notice where the big percent movers were. It came from the extremes, right? You had the best by far got smashed, and the worst by far had big gains. So there you are. Wheat and precious metals. Gold. Oddly enough, oil exploration and energy. I think those are just the rebounds from the oversold conditions. We'll see if there's any legs in materials because they had a pretty good second place. It may be safer to look at the mid caps in terms of narrow versus broad payoffs. Latin America, that may be worth looking up there. Commodities. I think that's reflect that makes gain. So DBC is a blend of four categories of commodities. You have base metals, precious metals, energy, and agriculture. That's that probably needs to get onto the calendar right now. And I'm just liking treasuries, just like them. Our two darlings, Apple and Microsoft, got smushed, but Home Depot is remaining unscathed, last man standing. So Home Depot and Caterpillar, the two opposites of high tech. That's just two hardworking companies right there. Caterpillar for big machines, Home Depot for home improvement and whatnot. Chevron did well because of the bounce in energy, and Coke. Maybe there's some more follow through in there. Sector spiders. Little banks, like compared to regular financials. So those smaller banks now are starting to catch up. And silver is just as good as it can be. Inside the U.S., it has been tech. That's the NASDAQ in that upper right-hand corner. Taiwan, Latin America, and Brazil. Tactical plays, that's always going to be an intraday that grows into a swing. I don't have a position, a long-term philosophical position on them, but it's pure tactical. These countries in here that are green and white or green and yellow in strength, and that's this category. Was good, now great, possibility of exploiting new strength. And then all of these that are white and green, these are ones that are falling out of favor. Like that's important. That's tech and growth and semiconductors. That white and green is this one here. Was great, now just good. Preserve your profits. Be ready for a resumption, but as the second wave or the second coming, if it can hold support levels. So there's a pullback now. There's an opportunity to start framing these trades. Let's just go to the daily quick. Intel and Goldman, Microsoft and IBM. Still Amazon and Simon Property Group in the max pains. Hard day at work here. McDonald's, Coke, Home Depot. Now that there's been 2 days of sell-off, now you can start seeing the auto framers starting to populate. Look how bad Intel was compared to the other members of the Dow. Only a handful of dojis. Today was more of a decisive selling day. More dojis in the ETFs, though. Asia less Japan, and that's a 551W, so that's a possibility. Look how good gold and silver have been. Silver, gold, Pfizer, Walmart. And then our former superstars, Tech, Apple, Microsoft, Intel, now underperforming dramatically. It's part of that sector and company cycling. Goldman, Intel, there's your four right there. Frame those. I'm going to frame them and talk about them on Sunday. I'm liking this MDY. I'm going to do a little more work on that one. So look at these pinch boxes here. Mid caps, diamonds, SPY. So the whole market is poised for a big breakout move in either direction. A lot more things now in the fall. And even a few now in the winter. That's where the weakness is going to be. I like that Treasuries is still early in the summer and has room to gain as a defensive play. So I'm liking that. The magnitude of Intel's loss dwarfs everything else, but still plenty of things suffered on a 3-day, made a new 3-day low. Silver, gold, and treasuries among the ETFs, and also a significant number of sell-offs. We talked about this earlier this week about getting ready to roll over. Rejected the Z plus 1. So now the move down to here is possible, which would bring it back to 300. It's the crucial level. And then there's our 315. That's a 5% sell-off, and this would be about a 10% sell-off, basically, at 300. This is This is a typical critical state starting to form where you can see a large move available in either direction. The last time it was up in that level and rolling over, it came all the way down below the average here. So that could bring it back. That would get it back to like 300 if it did that. Volatility is basically back to normal. And we are well in line with historical trends for the slope stat. Still bullish, but not crazy. So the 90 is rolling over. The last time it rolled over, just saying. So when you see the 30 in that kind of condition, and the 90 rolling over, and the 10 also weak, that thing is poised to come down again to 300. And then the edge of the river is basically 315. So those are two key numbers. All right, that's everything I want to cover for tonight. No Sunday night podcast or a Saturday night podcast. I'm going to do it tomorrow morning. I'm going to talk about assessments. And then Sunday, I'll be doing some trade frames on things that you post in the Campfire that you'd like me to take a look at. Okay? So take advantage of that opportunity if you're interested.